Can we quickly revise what we've discussed so far in amalgamation? Amalgamation in practical sense is divided into several classifications like amalgamation, absorption and external reconstruction. However, for the purpose of accounting under accounting standard 14, amalgamation is classified into two categories. One is amalgamation nature of merger, two amalgamation nature of purchase. Merger purchase classification is done based on AS 14. For AS 14, based on AS 14. AS 14 gives us 5 conditions. If all of the 5 conditions are satisfied, it is merger. Even if one among 5 is not satisfied, it is purchase. Shall we quickly see what are these 5 conditions? Condition number 1 says that all the assets and liabilities of transferor company should be taken over by transferee company, and this will include reserves and surplus. After condition number 1, let's quickly see condition number 5, which is continuation of 1, which says that all assets of transferor should be taken over by transferee at book value. We cannot take it over at agreed value. However, there are exceptions. If you are changing the value of the asset for bringing in uniformity in accounting policies, then okay. Otherwise, if there is change in the value of the asset, it will become amalgamation in the nature of purchase. Got it? Then condition number 2 says that minimum 90% of the shareholders of transferor company should continue to be equity shareholders in transferee company. Exception is for the shares held by transferor directly by itself or through its subsidiaries in the transferee company. You get that? So in the transferor company. The next thing that we need to notice, how is the second condition fulfilled? The second condition is fulfilled by issuing purchase consideration to equity shareholders of transferor company by way of equity shares in transferee company. This also has an exception. For fractional part, if in case you give cash, it's okay. For other than fractional part, if you give cash, it will turn into amalgamation nature of purchase. Then we have fourth condition, which we are not going to look into in the problems that we're solving. That is, business of the transferor company should be continued by transferee company. If all of these 5 conditions are satisfied, then in the books of transferee company, we are going to follow pooling of interest method. However, even if one among these 5 conditions is not satisfied, it will turn into amalgamation nature of purchase, and we are going to follow purchase method. Accounting standard 14 doesn't recommend any accounting for transferor company. There we follow dissolution, liquidation or realization approach as per generally accepted accounting principles. Shall we now quickly see what are the accounting entries in the books of transferee under pooling of interest method as well as purchase method? Under pooling of interest method and purchase method, remember the story. First the box is received, then the box will be unlocked, assets and liabilities will pop out, then we pay the money, then the box will be kicked, we pay the money to liquidators, then the assets which are there below will be arranged after considering DRUMS, drums. It will be drum if it is merger, it will be drums if it is purchase. Let's discuss the entries quickly. The first entry, the box is received from the liquidators. When the box is received from the liquidators, that box is called as business purchase. So we write the entry as business purchase account debit to, very good, liquidators of transferor company account. Then we will open this box. When we open this box, from this box will pop out all the assets and liabilities. So assets account debit, liabilities account credit, and will also credit business purchase account. If it is amalgamation in the nature of merger, we are going to write all the assets and liabilities including reserves and surplus at book value. And difference between debit and credit will not be written to goodwill or capital reserve, instead it will be written to reserves and surplus. However, if it is amalgamation in the nature of purchase, we will not write all assets and liabilities. We are going to write only such assets and liabilities which are taken over at agreed value, and we will never write reserves and surplus in this case. If there is difference between debit and credit, debit will be goodwill, credit will be capital reserve. Capital reserve and goodwill both will not coexist in balance sheet. We will net it off at the end. This is the difference between pooling of interest method and purchase method. So we opened the box, we've taken the assets, we've taken the liabilities, we've kicked the box. Now liquidator who got the box is waiting. Well, let's pay the consideration to him. When you pay the consideration to him, the entry is, we would write the entry as liquidator of transferor company account debit, and we would give them equity shares, preference shares, debentures, cash. We can issue them at premium or at discount. If there is premium, we will credit security premium. If it is discount, we will debit it. Same will be the entry whether it is amalgamation nature of merger or purchase. Both the cases it is same to same. So we paid the PC also to them. Then what should we do? DRUMS. S won't come if it is purchase, sorry, merger. What is D? Debenture. Debentures of transferor company will be taken over by us in our business purchase entry. Those debentures are no more valid. The reason being that company itself is shut down. How can the debentures be functional? So we'll cancel the debentures. We do this by debiting debentures in transferor company account debit. Credit, we can give them debentures in our company. We can give them equity shares, preference shares, cash. Whatever we give, we credit it. If there is premium, we credit. If there is discount, we debit. So entry is debentures in transferor company account debit to equity share capital to preference share capital to debenture to security premium. If there is discount on issue, debit. You get that? This is the entry. Same would be there. Whether it is merger or purchase, there would be no difference. D over, then R. Realization expenses. These realization expenses should be actually incurred by transferor. But if they don't pay, we pay it on their behalf. When we pay, usually we write expense to cash. Here we can't write expense to cash because it is not our expense. If it is merger, their reserves will become ours. We're paying it out of their reserves to them. So we write reserves and surplus to cash. However, if it is purchase, we don't take over their reserves. So what we pay to them is out of goodwill. We are not getting any benefit out of it. Or even if we get, it's not tangible. So if it is amalgamation in the nature of purchase, entry for realization expense paid will be goodwill account debit to cash. If it is amalgamation nature of merger, we write reserve account debit to cash. Understood? D over R over UMS. U, unrealized profit. Unrealized profit arises because one has sold goods to another. Transferor has sold goods to transferee, or transferee has sold goods to transferor, and these goods have been not sold to outsiders. They have retained with them. Against this, there is unrealized profit. If it is downward, as in the transferee company has sold it to transferor company, transferee has sold it to transferor, it is downward. In this case, stock will reduce, stock credit. Debit will be out of the profits of transferee. So we'll straight away write general reserve. General reserve account debit to stock. You can write P&L account, general reserve, or reserves and surplus, whatever is available. If it is downward, there is no difficulty. If it is upward, as in the goods has gone from transferor company to transferee company, we call it upward. Here also stock value will reduce. We credit stock. But what to debit depends upon what is the nature of amalgamation. What to debit depends upon the nature of amalgamation. If it is amalgamation in the nature of merger, then we write reserves and surplus because we've taken over their reserves. In that only profit is included. If we don't take over their reserves, that is amalgamation is in the nature of purchase, then we'll write goodwill account debit to stock account. Such decrease in the value of the stock will be debited to goodwill. D over R over U over M, mutual indebtedness, meaning one owes the money to the other. This is because of the debtor-creditor relationship that they have between them. So whenever there is debtor-creditor relationship between them, what do we do in that case? Reduce debtors, reduce creditors. Reduce bills payable, reduce bills receivable. Reduce trade receivables, reduce trade payables. So liability reducing we will debit, asset reducing we will credit. Entry will be TP to TR or BP to BR or creditors to debtors. By this our debtors, creditors also will reduce. Last item, statutory reserve. This entry will come only in the case of amalgamation in the nature of purchase. This is because if we say amalgamation is the nature of merger, in the initial entry, all by itself, we've taken our statutory reserves. So we don't have to write another separate entry to account the statutory reserves. So what is the entry that we write? Statutory reserve will be credited. Debit will be given to amalgamation adjustment. We write the entry amalgamation adjustment account debit to statutory reserve. Statutory reserve we know will appear in reserves and surplus. Amalgamation adjustment will also appear as a negative item in reserves and surplus. It will also appear as negative item in reserves and surplus. At the end of the term, we will reverse the entry. We will write amalgamation adjustment will be credit, statutory reserve will be debit, and this will be reversed. So this would have to be continued for the period for which the transferor company was supposed to maintain such statutory reserve, 2 years, 3 years, or whatever. We are however going to do only one balance sheet after amalgamation, so it would not affect us much. After this, we would have to prepare balance sheet. When you prepare balance sheet, remember the old balance sheet plus these journal entries what we passed now will affect our new balance sheet. In the new balance sheet, remember to show disclosure for shares or debentures issued for non-cash consideration. That is on amalgamation. This is how the accounting is done in the books of. Now, very good. Let's see accounting in the books of transferor. In the books of transferor, it doesn't matter whether it is merger or purchase because the approach that we follow is realization approach or dissolution or liquidation approach. What do? First, I'll tell you the story and then we'll discuss the entries. First, we transfer the assets to realization. Then we'll transfer the liabilities to realization. Then pack the box. give this box to transferee, collect PC from them. Then if there is any assets that they have not taken over, we will sell it. If there is any liabilities not taken over, we will settle it. Then we'll identify realization expenses, record it if we have paid, pay preference shareholders by transferring preference share capital to preference shareholders, preference shareholder to whatever we're giving them. In preference shareholders to payment, if there is any difference, that would again be debited or credited realization. So far, we have not seen any question where there is difference between how much is supposed to be paid and how much is paid. Even if it comes very simple, if you know this, you do it. If you don't know it, no, don't open two separate preference shareholder, equity shareholder. Open only one account, shareholder account. Transfer everything there, it will get settled. But you won't get full marks. If it is a 20 marker question, you would get 2 marks less because your realization profit will be incorrect and preference shareholder treatment is incorrect. So you get 18 out of 20. If you know it, very good. If you don't know it, you can do this. So after that, you identify realization profit or loss, transfer to shareholder. For that, transfer entry is if it is profit, realization to shareholder. If it is loss, shareholder to realization. Then 3 items from the balance sheet are not transferred to shareholder. What are the 3 items? Share capital, reserves and surplus, accumulated losses. Share capital, reserves and surplus, accumulated losses will be transferred to shareholder. Your entry will be equity share capital debit, reserves and surplus account debit to shareholder account debit to accumulated losses. Once we do this, then only thing that's left is settlement to equity shareholder. We'll write equity shareholder account debit to whatever we give them. Equity shares in transferee company, preference shares in transferee company, debentures in transferee company, can be cash also. Once this entry is passed, entire ledger should get closed. That's what we discussed. Now we'll quickly discuss the entries once again. Shall we? First, for transfer of assets, entry is realization to assets. Asset is credit, realization debit. All the assets, whether taken over or not, should be transferred to realization at. Very good. Exception, 3 items. Share capital, reserves and surplus, accumulated losses. One more item, bank. If it is taken over, it will be transferred. If it is not taken over, if it is used to pay realization expense or settle some liability, will not transfer it here. You get it? Then transfer all the liabilities to realization. For this entry is liabilities account debit to realization. Again, don't worry about the agreed value. Write this entry at book value. Debentures is one place we need to be cautious. Be little cautious. They'll give redemption premium, they'll give issue premium, color items they give, but transfer it at book value. Get it? Once these 2 items are transferred, this realization box is passed to transferee and transferee owes us money. Create transferee company account debit to realization. This will be for purchase consideration amount. After this, immediately we'll receive our PC. Whatever we receive, cash, bank, equity shares, preference shares, debentures, whatever we receive in that company, debit that and credit transferee company. So receivable from them is over, we have received this. All of this will be used to settle the liabilities not taken over or shareholders, that is equity and preference. Once this is over, we'll pay realization expense. If we pay realization expense, we'll write realization account debit to bank. If we receive it back from the transferee, we'll write bank to realization. That will be reversal. Got that? If any assets are not taken over, we will sell the assets, bank to realization. If any liabilities are not taken over, we'll settle the liabilities, realization to bank. This entry, bank to realization and realization to bank, for assets not taken over, sold, and for liabilities not taken over, settled, will be passed at the value at which we settle. Don't worry about profit or loss, it will automatically get adjusted in realization account. Once this is done, settle our equity preference shareholders account, transfer preference share capital to preference shareholder, any difference will be realization. Then pay preference shareholders debit, give them whatever needs to be given. Then close our realization account by identifying profit or loss, realization to equity shareholder or equity shareholder realization for profit or loss. Finally, last but one entry, transfer share capital and reserves to our shareholders. Right? Share capital account debit, reserves and surplus account debit to shareholders. If it is loss, shareholder account debit to accumulated losses. Then finally, payment entry, equity shareholder account debit to X% preference share, equity share, debenture, cash, bank, whatever you give. Once you pass this, everything will get closed. PC can be given under 4 methods: NATO method, lump sum method, PC method, intrinsic value. Be little cautious. You don't have to try and identify and then learn it separately. Language of the question itself will make you understand. It is not at all a problem if you fail to spot what method is it. There is no point in identifying what method is it. Till the time you are able to solve the problem correctly, it is all good. You all got this? Very good.